If you advise any clients with global portfolios, you've probably had a nightmare or two about the PFIC regime. And let's be honest, this isn't just another complicated piece of tax law. It is a punitive minefield, where just one tiny misstep can lead to absolutely catastrophic financial consequences. So today, we're going to go deep. We'll use Form 8621 as our guide to navigate the rules, the critical choices you have to make, and the very real audit risks that, frankly, keep practitioners up at night. So, how in the world do we even start to tackle this beast? Well, here's our roadmap. First, we're going to define the problem. Why does this brutal regime even exist? Then, we'll get our hands dirty and dissect the key document, Form 8621. From there, we'll hit the big one, the critical elections you have to make and the punishing consequences if you don't. And finally, we'll zoom out and see how this all fits into the bigger picture with state taxes and, of course, audit defense. All right, let's dive in.
All right, so where did this whole thing come from? Well, the entire PFIC regime was born out of the Tax Reform Act of 1986. The reason behind it was actually pretty simple. Congress wanted to kill the advantage of deferring U.S. taxes by parking money in offshore funds. The whole point was to make sure that investing in a foreign mutual fund would never be more tax-friendly than investing in a domestic one. So what exactly makes a foreign corporation a PFIC? Well, under Internal Revenue Code Section 1297, it's surprisingly simple. It only has to meet one of two tests, either the income test or the asset test. And that either-or part, that's what's so important here, because it casts an incredibly wide net. You only have to trip one of these wires. And here are those two gateways. First, under the income test, if 75% or more of a corporation's gross income is passive, we're talking dividends, interest, royalties, that kind of thing, boom, it's a PFIC. Or if it dodges that one, it might get caught by the asset test. If 50% or more of its assets are held to produce passive income, then yep, it's a PFIC. As you can imagine, a whole lot of foreign mutual funds sail right through one of these. So what happens if you meet one of those tests? The consequence is both severe and immediate. It triggers a mandatory annual filing of Form 8621 for every single PFIC investment. And what's really crazy is that this filing is required even if the U.S. person's income is so low they wouldn't otherwise need to file a tax return at all. It's an absolute inescapable burden. Okay, so we've laid out the problem. Now let's turn to our primary compliance tool, or maybe our compliance armor, Form 8621. And please, don't be fooled by how administrative the first few sections look. The information you enter in the header and in Part 1, that sets the stage for everything else. It directly impacts your tax calculations and, maybe more importantly, your audit risk profile. The header is basically your first chance to mess things up. That entity classification isn't just a label. It dictates who is on the hook for the tax. That little FATCA checkbox, it seems so simple, but if it doesn't line up perfectly with what's on Form 8938, you're basically flagging yourself for an automated IRS notice. And checking that QIC box for a foreign insurance company? You might as well send a handwritten note to the IRS saying, "Please come audit me." Now, Part 1, which is mandated by IRC Section 1298F, essentially acts as a detailed inventory system for the IRS. Every single detail here matters, but pay special attention to the acquisition date. That date is the absolute mathematical bedrock for the default tax calculation. If you get that wrong, the entire computation is garbage. And this table right here, it's a fantastic illustration of how the IRS sorts through its workload. The form uses this tiered system to figure out who to look at. For smaller holdings, you just check a box. But once that value tips over $200,000, an exact valuation is mandatory. They are literally telling you what they care about most, and it puts a much higher compliance burden on the taxpayer. And that brings us to Part 2. I would argue this is the single most critical junction on the entire form. The election that is made here, or, just as importantly, the failure to make one, is what permanently seals the taxpayer's fate for this specific asset. It is the point of no return. So this is it. This is the question every advisor and taxpayer has to answer. Which path are you going to choose? The decision you make is pretty much irrevocable, and it carries massive financial consequences. There are 3 potential paths, and you really need to know that one of them is dramatically more punitive than the others. Okay, so path number 1 is the Qualified Electing Fund, or QEF, election, under Section 1295. This is usually the best option, but there's a huge catch. You have to get something called a PFIC Annual Information Statement from the foreign fund. And let me tell you, that's often impossible to get. Path 2 is the mark-to-market election under Section 1296. It's simpler, but it converts all your gains to ordinary income. And if you fail to make either of those elections, well, you fall into the default path, the absolutely brutal Section 1291 regime. And with these elections, timing is everything. If you fail to make a timely election, that asset becomes permanently tainted by the default rules. It's like it gets a permanent black mark against it. Trying to fix it later requires either meeting some really stringent standards for retroactive relief, which is both difficult and expensive, or making a purging election, which basically triggers an immediate, painful tax hit just to wipe the slate clean. All right, now that we understand the three forks in the road, let's actually walk down each path and see exactly where they lead. We're about to get into the mechanics of it all, and you are going to see just how wildly different the financial outcomes can be. The gap between making the right election and falling into that default regime, it is truly night and day. What I love about this slide is how clearly it lays out the trade-offs. Look at the QES election. It preserves capital gains treatment, which is great, but it requires that almost mythical statement from the fund. Then you have the mark-to-market election. Administratively, it's easier, but you lose your capital gains treatment. And then there's the Section 1291 default. You convert your gains to ordinary income, and you get hit with a punitive, non-deductible interest charge. It's just the worst of all worlds. This formula right here, this is the trigger for all the pain that comes with the default regime. You see, an excess distribution happens when a distribution in the current year is more than 125% of the average distributions you got over the prior 3 years. On top of that, any gain you have on the sale of the stock is also treated as an excess distribution in its entirety. So once an excess distribution is triggered, this 4-step punishment machine just kicks into gear. First, the gain gets spread out pro rata over the entire time you held the investment. Second, the part that's allocated to prior years gets taxed at the highest possible tax rate for those years. It doesn't matter what your actual bracket was. Third, they tack on a daily compounded interest charge. And finally, as a last insult, any capital gain character is completely vaporized. So what does this all add up to? It's a truly brutal combination of factors that can shove the effective tax rate past 70%. Just think about that for a second. For assets you've held for a long time, the total tax bill can literally be more than the investment is even worth. It can completely wipe out years and years of economic gain. It's just devastating. But hey, just when you think you've finally gotten a handle on the federal rules, that compliance web, it gets even bigger. It actually extends down to the state level, and it connects to this whole global landscape, creating all these extra layers of complexity that can easily trip up even the most seasoned practitioner. Let's just take California as an example. The state's franchise tax board has absolute non-conformity with the federal PFIC rules. What that means is any income you reported under Sections 1291, 1293, or 1296 has to be completely backed out of your state return and treated as a specific state adjustment. You're basically keeping a whole separate set of books just for California. And you have to remember, PFIC reporting doesn't exist in a vacuum. It crosses over with all these other complex international rules, like the Controlled Foreign Corporation rules on Form 5471. Then you've got parallel reporting for asset transparency, like FATCA on Form 8938, and your FBAR filings. It's this incredibly tangled web, and it was all designed to counteract the tax deferral benefits that are offered by territorial tax systems all over the world. So we're going to wrap this up with what is, quite possibly, the single most dangerous trap in the entire PFCIC regime. This is a provision that every single tax professional has to understand, especially when you're defending an audit, the Statute of Limitations. This timeline shows you the absolutely terrifying power of IRC Section 651C8. So imagine this. In year 1, a taxpayer files their return, but they unintentionally miss one small Form 8621. By year 4, the normal 3-year statute of limitations has expired for the rest of that return. But now it's year 10, and the entire tax return, including every bit of domestic activity, is still wide open to an IRS audit, all because that one form was never filed. The audit clock stays open indefinitely until 3 years after that missing form is finally put in. And that brings us right back to where we started. The stakes in PFIC compliance are just extraordinarily high. A single missed form can have permanent, life-altering, catastrophic consequences. So the final question here isn't just academic, it's a direct challenge to all of us.
Is your client's and your own international compliance really as secure as you think it is?